Let me take out your. So, any question from last day's one?
No, no.
Tomorrow is your exam, correct?
Yes.
When is your exam?
They postponed it to Saturday.
Okay, so tomorrow I am getting, correct?
Yeah.
Okay, we will finish by then. Today, I guess we can start finish with the one which I'm doing 7, yeah.
Yeah.
7, I was like slide 34 or something like that. 1 minute.
Mm.
Hello, sir. Lahari, be on call, okay? Okay, don't leave. I'm talking with sir.
Okay.
Shit. Hello. Sorry, you have to wait. I was talking with sir. Sir called me.
Okay.
Okay. So let's start. You can see the screen.
Yes, I can.
Okay. So last day we have done till
Sure. We did till like slide 28.
slide 28. Okay, little bit left, like last 10 slides according left, and then we
Yeah.
will with that one. Swap we have started. contracts. 20. You have revised at home?
Yes, I have been revising.
Any questions from there? Last two are very important. I have seen your message.
Mm-mm-mm.
And
No,
then,
but
yeah, tell.
actually, like the exam, there's a system crash going on in our university, so they
Okay.
postponed the exam to Saturday. But if still the system crash cannot be like fine, then
Mm-hmm.
it will be like pushed to Monday.
Mm-hmm.
But still to
Then
be
we
on the
can by
safe,
then finish that one also, the one which is there back, which I have done till 50 slides. That we can do.
the chapter 6, yeah.
Yeah,
And
chapter
then
6.
maybe like if there's some time we could, I have like some sample papers.
Mm-hmm.
We
Then
could
at the
do-
meantime, we can do that. Correct.
Yeah,
Yeah, if your exam get postponed. But we
yeah.
will be finished with the syllabus. That's good.
Syllabus, yeah, that's the main thing.
Before that, that's a good. And if there is time, you can send that.
Sure.
Chapter 7. I'm opening your PPT only.
Mm.
So just revise. By then, you tell me what you remember and what you not.
Yeah.
Future context, what was?
Standardized agreement to buy or sell the asset at a predetermined price on a future date.
Yes. And what was swap contracts?
It's the over the contract agreement between two parties to exchange like two or more cash flows like over time.
Yes. Okay. So last day we did with the swap contract which started and we have done some sums.
Yeah.
Now today we will be doing what is the market value of a swap contract.
Mm.
What is the market value? T equal to 0 I started with. T contract has no market value. Okay. The
Mm.
present value of the change in the forward price at the specified spot rate. Sum. So T is equal to 0. The spot price like 1, 2 like that last we were doing. So at initial it is T0. Now when a swap contract is first created, its value is 0 for both parties. That means what? The present value
Mm.
of the fixed payment is equals to present value of floating payment. Okay. So neither side is at an advantage initially. Now as the time passes, T will be greater than equal to 0.
Yes.
So market change, condition change, and also the forward price, the interest rate, and spot rate move. Okay. So
Mm.
this changes shift the value of the swap. Okay. So positive to one side, negative to the other. Now how to compute that market value? The value of a swap at any time is what? Is the present value of the difference between the original agreed prices and the new market prices. Okay. So it
Mm.
is discounted at what? At the current spot rate. So now there are two equivalent ways to look at it. What are they? Forward based view and level payment view. Okay.
Yeah.
Forward based view and level. Forward based view means value is equals to PV of what? Present value of old forward price minus new forward price. And each forward contract embedded in the swap. Revalued at the current forward rate. Okay. And what is
Yes.
level payment view? Value is equals to PV of old fixed swap payments minus new fair swap payments. So if the fixed swap price you pay is above current market fair rates, so your contract has negative value. That is a liability. Okay. And if it is below, it has positive value. That is the asset. Okay. So what is the key idea I told you at inception? What is the market value? 0. After
Mm.
inception, the value of the swap is simply what? The PV of the changes in forward or level price at the current spot rate. So that is why swaps are actively traded and can be marked to market daily. Their value is not fixed, but it depends on interest rate and forward price. Correct?
Yeah.
That I have done. Okay, I have done the sum for 7.4. Now here, okay. Now there is an example.
Mm.
7.5. Market value based on that. So it is from example 7.4 only.
Yeah.
So here, for example, assuming after the initial contract, what is the spot rate? That is 1 year.
Mm.
2 years, 4.5%. So here, old forwards, if I talk about, so year 1 it is 100 and year 2 it is 110. Okay, and if I talk about new forwards, that means market has shifted. So here, year 1 is 105, year 2 is 130. So now what will be the prepaid price of the new swap contract? So what is the formula? 105 by 1.04 plus 113 by 1.045 square. Okay. So 105 by 1.04. So that is 100.96.
Yeah.
113 by 1.045 square. So that is 103.7. So what is the prepaid price? 100.96 plus 103.72. So that is 204.68. Okay. So what is the prepaid swap price? 204.68. Now next of the new contract. So then we now
Mm.
convert the prepaid value into two equal annual payments. X. So what is the equation? 204.68 is equal to x by 1.04 plus x by 1.045 square. So what are the discount factors? 1 by 1.04, so that is 0.9615. Okay. And 1 by 1.045 square, that is equivalent to 0.9157. So what is the sum? 772. So x is equal to 204, which we have already find out, 68
Mm.
by 1.8772. That is around level annual sum. Next, I think market value of the original swap contract. Just remember all the formulas, okay?
Yeah.
Contract. So here original prepaid price was 196.80. That is from your 7.4. And new prepaid price will be 204.6. So then my market value will be 204.68 minus 196.8. So that is 7.80. So what is the answer? The market value of the original swap will be 7.80 to the buyer of cocoa. Okay,
Yeah.
this is there. Next, so since cocoa forward price rose from 100 to or 110 to 105 or 113. Okay, so that means what? The cost of entering a new swap increased. Okay,
Mm.
so the firm which is holding the old swap is in a favorable position. So that is asset worth 7.80. So this shows, how swap contracts fluctuate in value after the inception. Now next, interest rate swap. Okay, so what is an IRS? It is a financial contract where two parties exchange interest payment on a national loan amount. So what is the main purpose? The main purpose is to manage exposure to changing interest rate.
Mm.
That is turning uncertain floating rates into fixed one, or vice versa. Now, why it is needed then? Why is it needed? When you take a loan like a mortgage, banks usually charge you a floating interest rate. That is a variable rather than a fixed rate. So floating rate depends on what? Some benchmark borrowing rate or interbank offered rate. Okay. Like one Libor or SOFR or A Libor in Malaysia. So that means your loan payment may go up or down each year as the BR changes. So here the example, if I take from this only, see they have given an example. Like I took around amount from CIMB. Okay. So loan interest is what? It's the borrowing rate plus 0.5. So if borrowing rate is 3.9, then I am paying 4.4. 4.4 is what? 3.9% plus 0.5%. Okay.
Yeah,
And if BR is 4.5, then what I am paying? 5.
5.
4.5% plus 0.5%. So that is 5%. This shows the uncertainty of floating rate. So your payment depends on future market condition. Okay.
Okay.
So how the interest rate swap helps? From this we understand how interest rate swap helps. So the borrower may enter into a swap with another party. So like a bank or financial institution. Okay, so the borrower agrees to pay a fixed rate, that is 4.8% every year. So in exchange, they receive payments equal to the floating rate. So that is, and this way the floating risk is cancelled out. The borrower effectively locks in a fixed cost of borrowing. Okay. So a floating rate, which is unpredictable, linked to market borrowing rate, an interest rate swap, which convert it into a fixed rate, giving certainty to borrower, and it's widely used by corporation, bank, and even government to stabilize financing cost. Here,
Yes.
next, what is LIBOR? LIBOR means London Interbank Offered Rate. Interbank. Okay, it's written. And serve as the first step to calculating interest rate on various loans throughout the world. So it was published by International Exchange. So often it is called ICE LIBOR. And it presented what? It represented the benchmark interest. It represented the benchmark interest rate at which major global banks lend to one another in the London interbank market. So LIBOR was quoted in multiple currency: USD, GBP, EUR, JPY, CHF, and for different maturities also. That is overnight, 1 month, 2, 3 month, 6 month, 12 month. Okay. So how is LIBOR used then? LIBOR served as the reference floating rate, okay, in millions of financial contracts worldwide. Loans like mortgages, corporate loans, derivatives like interest rate swap, future options, okay, and bonds and structured products. Okay, so how I can tell, for example, a loan contract might be LIBOR plus 1%. So here the borrower pays interest equal to current LIBOR plus a fixed month. And in interest rate swaps, one leg of the swap is often linked to LIBOR, and that I call as the floating side. Okay, and other leg is fixed. So how we can say, for example, firm A agrees to pay fixed 3%, and firm B agrees to pay LIBOR plus 0.5%. Okay, and payments are netted each period. So this allows firms to hedge exposure to floating interest rate. Okay, so LIBOR is essentially the average rate at which top banks borrow from one another in London. It became the global standard benchmark for floating rate. Next, 7.6. So continue. Your company has an outstanding loan that is $100 million. Okay, so this amount will be paid at the end of 3 years. Now, every year the company must pay annual interest based on LIBOR. So here, what is the problem? First, we have to understand the problem. Floating rate interest, that is uncertain. Okay, so fluctuate year to year. Okay, now company prefers stability and predictability in payments, in its payments. So what is the solution? The company can enter an interest rate swap with a bank or counterpart. Okay, so here company pays fixed rate. Example, 4.5% annually. Okay, on 100, and company receives LIBOR payments why? To cancel out the floating interest which is owed to the lender. So what is the mechanics? Any question till now?
No, no.
What is the mechanics then? To understand, without the swap, company pays LIBOR multiplied by $100 million each year to the lender. Okay, and with the swap, company still pays LIBOR multiplied by 100 million, okay, to the lender. But Under the swap, it receives Libor multiplied by from the counterparty. So this offsets the floating payment. So what is the net effect? Company only pays the fixed swap rate, that is multiplied by 100 each year. Okay. So what the example requires then? Find the annual swap rate, the fixed percentage per year, then find the fixed annual level swap rate. Same idea. So an interest rate swap allow the company to hedge interest rate risk and lock in certainty even though the original loan is floating. Next. Okay. A sum is there. So just try this and tell me what will be the A1 answer.
Mm.
You're trying?
Yes.
Okay. Just tell me. Then
So for the part A,
mhm,
we have to find the discount factors from the spot rates first.
exactly. Exactly. So discount factor, the formula we are first. S1 is given.
Yeah.
This one is the S1. You have taken it out. S2 is this one. S3 is this one. S4 is this one. So first the annual swap. So first we will take out the discount factors.
Yeah.
Very good. So here we are having the discount factors. So D1 is 1 by 1 plus S1. That is 0.961538.
Yeah.
What is D2?
0.915730.
0.915730. And what is D3?
0.86384.
1 by 1 plus PQ. That is 0.863838. So first we find out the answer. So here the forward, here I to I plus 1. So that is from spot rates. Okay. So 1 plus I plus 1, that is 1 plus Si plus 1 to the power I plus 1 by 1 plus Si to the power I. Okay. So
Mm.
here 1 will be 0 to 1. Okay. So we calculate F 0, comma 1. So S1 4.00%.
Yeah.
Similarly for year 2, what will be year 2? 1, 2, 2. So that is F 1, 2. So that's fraction.
Mm.
1.045 to the power 2. Like we find it out. Similarly for year 3, that will be 2 to 3. Similarly, we find it out, that is 1.05 to the power 3, that number. Okay.
Mm.
So equivalently, what we get is that if I plus 1 is equals to di by di plus 1 minus 1. Correct?
Yeah.
Now, you have another question. What is the question? Equivalent level annual swap rate.
Yeah.
This was the answer you did?
Yeah. The formula was like that.
Okay. The one, yeah, for the discount. Now, 3 here. So here, par fixed rate. So here, S satisfies. So here, it will be
Mm.
S summation and I is 1 to 3. So DI is equals to 1 minus D3, or S is equals to 1 minus D3, D2, D3. Okay. So here S will be 1 minus 0.863838. Okay. So it's 0.961538 by 0.915730 plus 0.86383. So here the calculation, 0.86383. So that what comes, that will be the floating, calculate the floating leg forwards. Just calculate and tell me what is coming for
Yes.
the 3 years. So the calculation is clear
Yes, it is.
of roughly 4, 5 and 6.01. These are in percentage. Okay. And the equivalent fixed swap rate is about coming.
Can you just scroll up a little bit, miss? Later.
Should I show for calculation?
Yeah, yeah. I was just copying it. Yeah, this part.
You do and tell me, okay?
Yeah, it's done.
Uh, Auntie, জিওলজি MENN ME1 SMCQ এটা আজকে কিছু আমাদের নেই তো, এই পাঁচটাই বাকি, এই পাঁচটাই বাকি আছে, আমি কালকে যেগুলো জিজ্ঞেস করবো, ঠিক আছে? তাহলে ওই জন্য তো, ওই কনফারেন্সটার জন্য, ঠিক আছে? So calculation is coming
Yeah, it's 0.04968.
0.04968.
04969.
So that is in percentage. So
Yeah,
that will be around
4.9%.
4.97%.
Yeah.
Okay, 4.967%. I round it off.
Mm.
Clear?
Yes.
Next. So new problem is selected. Just finish here from your side.
Mm.
So what are the types? There are different types of interest rate swaps.
Okay.
Okay. Yeah, the screen is there. You can see the screen.
Yep.
So these are the different types. First, amortizing swap. What is that? Interest rate on declining outstanding balance. Okay. So here the notional principle is what for this? Amortizing swap is the base on which interest is calculated declines over time. Okay. So interest payment reduce as the loan balance amortizes, just like a home mortgage. Okay. So it
Mm.
is used when the underlying loan is being gradually. So here the amortizing swap will be like, say, for example, company issues a loan. Okay. So here that pays down 10 million principal every year. So here it is swap notional shrinks accordingly. Okay.
Mm.
Next, accreting swap. It is just the opposite of amortizing. The notional is increasing. Okay. So here interest payment, grows larger. When? Because the exposure grows.
Yeah.
So it is useful for projects, where financing needs increase over time. Next, deferred swap. What is a deferred swap? A swap that does not start, but at a future date it starts, not immediately. So both fixed and floating payments are deferred for n years. Okay. So it is
Mm.
also called a forward starting swap. So it is useful like if a company expects to borrow in the future and wants to lock in interest rate now. And what is a swap called? It is a set of swap rates for a range of swap maturities. Okay. So
Yeah.
graph of swap rate for different maturity, 1 year, 2 year, like that, just like the government bond. And I can say you it is widely used as a benchmark in financial market. Why? Because it reflects market expectations of interest rate. Different swap type have company, to customize their interest rate exposure, which is depending on whether their financing needs are shrinking, growing, or starting in the future, or it is spreading across different maturities.
Mm.
So, next slide. There is an example. Let's do it. 7.7. So how we do this? Your company has a loan of $100 million. Okay. Principal will be repaid when? At the end of 3 years. But interest must be paid annually.
Mm.
At the end, so based on LIBOR. So what is a 1 year deferred swap? What if the company wanted to this one? So a 1 year deferred swap, a deferred swap, it is also called forward starting swap. Does not start today, but at a future date. Okay. So in this case, the company would pay LIBOR in year one as usual. So there is no swap in place. Okay. Next, from year 2 onwards, you enter a fixed versus floating swap. Okay. So that means what? In year 2 and year 3, the company pays a fixed rate. Okay. And receives LIBOR. Offsetting its floating rate obligation. How it works? Now let's go to your example. Like the way I taught you without deferred swap. So without
Difference.
deferred swap, if you see your question, year 1, pay LIBOR multiplied by 100. Year 2, pay LIBOR multiplied by 100. Year 3, pay LIBOR multiplied by 100. And with 1 year deferred swap, year 1 still pay LIBOR, that is multiplied by 100. So there is no change. Now year 2 and 3. So there is swap activities. Swap activates. Swap activates. So here year 1, you still pay LIBOR. Okay, that is multiplied by this. So there is no change. Okay. And year 2 and 3, which I told you, swap activates.
Mm.
So here, company pay will fixed. How much? 5%. So company pays fixed, that is 5%. Company receives labor. And what is the net effect? Year 2 and 3 things. It becomes fixed. So that is 5% multiplied by 100. Okay. So why I told you why we are using a deferred swap, the company might expect rates to remain low in the short term also. So it doesn't hedge immediately, but
Mm.
it secures higher rate in the future, so it secures a fixed rate for later years. So this strategy, balances the short-term saving with the long-term protection. A one-year deferred swap lets the company continue with floating LIBOR for the first year, but then converts future obligation into fixed payments for the remaining term.
Okay.
There is a continuation. They have given us some in continuation. So we have to calculate the annual swap and equivalent.
Mm.
Do this. So how we do this?
One second.
For a one-year deferred swap, T is equal to 1, 2, 3. Okay. And
Mm.
this is S1. Use the given annual spot curve S2, S3, and S4. Now we have to calculate the annual swap rate of one-year deferred swap. So that is what? Forward I plus 1 from spots. So that is 1 plus I plus 1, that is equivalent to 1 plus I plus 1. 1 plus S1 to the power I. So that is what? Action. 1.05 to the power 3 of what? 1.045 square minus 1. So it will give you floating. You are having the value floating leg forwards the deferred swap locking. All the formulas do it very well. Okay, there are separate formulas.
Mm.
Say any question?
No, no.
Done. I'm going to the next. You are having another question. What is that? Equivalent level
And so annual swap rate.
annual swap rate. So that is fixed rate for both payments. Okay. So let discount factors be. So what is P1? 1 by 1.04. So that is 0.961538. What is P2? 1 by 1.045 square. So that is 0.915730. And what is P3? Q 0.863838.
Mm.
Now we will calculate S1 and 3.
Okay.
P1 minus P3. So S1 3, that is P1 minus P3 by P2 plus P3 minus 0.863838 by 0.915730 plus 0.86383,
Mm.
5.49%. See how you interpret. So it will come around annual. If I talk about the answers, annual deferred forwards is 5%, and that is for year 2, and 6.01% that is for year 3. Okay, and what is the equivalent constant fixed rate? For years 2 and 3. So that is 5.49% per year. So let's recap. Since you are having a slide, then I will do some sums and go to your new chapter.
Okay.
So this ends your syllabus. So summary point.
So for the previous one, if they ask like for the annual swap contract, then it's for like let's say year one and year three. It's
Mhm.
always like year one minus year three out of the ones in between, like P2 plus P3.
Yes,
Right. Okay.
exactly, exactly. And downstairs is plus
Yeah.
for the formula. Like what is the exact for what you are finding out? Like P2 plus P3, so it's there on the denominator.
Mm.
So a swap. Any further question?
No, no.
So a swap, just recapping, a swap is essentially a contract which covers a stream of cash flow over time, not just a off-time payment, but a forward is what? It's like a single payment swap. So it fixes the price for one future transaction only, and swap extends the logic multiple future payments. So price of a swap is usually expressed as a level payment. Okay, a fixed payment amount or rate applied consistently each period. Each period. Okay, so that balances the value of fixed versus floating legs at the start. And what are interest rate swaps? Most common type of swaps.
Mm.
Two parties agree to exchange interest payment on a notional principle. So what happens? One pays a fixed rate and the other pays a floating rate. That is, which we did, LIBOR plus paid. And what is the notional principle? itself is not exchanged. It's just the base for calculating payments. Payments are netted, only the difference between fixed and floating is actually paid. Swaps generalize forward into what? Multi-period contracts. Okay, so interest rate swaps are used for what? To hedge against interest rate risk or to speculate on interest rate movement.
Mm.
And I think today I have done, no, the
Mm.
type of that one. Today only I did. Yeah. So the different types, specific types and different types of swap are this. Deferred swap amortizing accurate. Okay,
Mm.
let's do some questions and then we will go to the next topic. Any question from this PPT?
No. These,
Question.
these questions are actually okay. I was looking at them.
Mm-hmm.
I think they're doable for future
Doable?
answers. I have done some. They're actually doable. Yeah.
Okay, so you want me to go to directly to the next slide, correct?
Yeah.
Okay. Okay, then we will go for that only. You have given future and swap contracts. 2 pages are there.
Mm.
Okay, so you have done rest of the questions.
I have not
Same
done
type of
them,
questions
but
like
I
what
will
you
finish
practice,
them.
correct? Yeah.
Mm.
See, BR plus 0.5, counterparty X. Just seeing the questions.
Yeah.
Okay. So tell me, what do you want to do? Directly chapter 8?
Yeah, I think we can do chapter 8, and then if there's time, we can revisit the questions.
Okay, okay, okay. Syllabus completion. Okay, yeah,
Yeah.
yeah, I got it. Okay, okay. Just let me take out your PPT then.
Mm.
This was chapter 7 done. Now chapter 8. Mm, Basic discrete valuations. And discrete valuations. Any idea about this?
I actually have done the topic, but I just don't remember.
Okay, okay. No, no, I just ask as I just ask at first.
Yeah.
Yeah. Okay, let's start together.
Mm.
Basic. It focuses on like what is a basic discrete valuation. This refers to valuing derivatives in a discrete time framework. Okay, you know, as opposed to continuous models like black spots. Okay, so the simplest discrete model is what? Is the binomial model. So at each time step, the underlying asset can go up or down by certain factors. Okay, so probabilities of movement are assigned. And the derivatives payoff like from an option is then discounted back. Okay, using the risk neutral measure. So now topics what we will discuss is time value of money, one period binomial option pricing model, multi-period binomial tree, risk neutral valuation. This will be there. Why it is important to study this? This is important to study. Why it's important. So here discrete models are foundational. Okay. So they help students understand how uncertainty and arbitrage conditions lead to pricing rules. Okay. So they serve as the stepping stone to advanced continuous time models. Okay, like it's calculus, Black-Scholes Merton. Practical applications, if I talk about, then it is option pricing, risk management, and corporate finance valuation. Now, first page. Price option by using binomial tree model. First, let's do with the on date. So here, what is a binomial tree? A binomial tree is a graphical model to represent the possible movements of an asset price over time. Okay. And at each step, the price can move up by a factor U or down by a factor D. Okay. And it provides a structured way to model uncertainty in financial markets. Okay, this is one. Next, what is a one period binomial trees? What is the concept? One period, one period binomial trees. Screen is visible, audio is visible.
Yes, yes.
Okay. So here the simplest case is only one time step. Okay, until the option expires. Okay. So here what you do, you compute two possible asset prices. You compute two possible asset prices. Okay, like up or down. Okay. And then calculate the option payoff. Okay. So it is using risk neutral probabilities. So it is using risk neutral. So the options fair value today is found by discounting the expected payoff. Payoff. Okay. So like pricing a European call option using only one up or down step, like that. Next, what are options pricing? You have done that. What is that? Remember? I did with you.
Options pricing.
Mm-hmm. On the previous slides.
Mm-mm.
What are they?
Is it the one where it also includes like the Black Scholes formula and the one like the
All
combination
put
of
options.
mm,
All put options, no.
yeah, okay. Like
Application of the, you're revising at home what I have already done.
mm.
Okay. To value derivatives like, that is, call options and put options. Call option means
The selling, right?
right to buy. Right to buy. And put options means right to
Sell.
sell. And what it involves? It involves calculating the payoff at expiry. And the discounted expected value today.
Mm.
Okay. So both European
And American.
is exercised only at expiry, and American Exercise
Anytime before.
expiry. Options can be priced. Okay. Next, risk neutral probability is very interesting.
Mm.
Risk neutral probabilities. So what we learned, instead of using real world probabilities, we use risk neutral probabilities. Okay, under which all assets are expected to grow at the risk-free rate. Okay, so what is the formula? P is equal to E to the power R minus D by U minus D. So what is the what formula? R is what? Risk-free rate. U is what? Half factor. D is what? Down factor. This ensures no arbitrage and makes pricing consistent. Okay.
Mm.
And finally, multi-period binomial trees. Multi-period binomial trees. It extends the one period model to multiple time steps. Okay. So it's more realistic. Why? Because options usually don't expire in one step. Because options usually don't expire in one step. And it creates a lattice or tree structure where at each step the asset can move up or down. Okay. So here there is backward induction is used. So you start with option payoff at maturity first. Okay. Then you work backwards, step by step to today.
Mm.
This approach, converges to continuous model like back scrolls. Very important. When the number of steps become very low. This is overall what we will learn. Now, let's go one by one. What is a binomial tree? So as I have discussed with you, what is a binomial tree then?
Graphical model to represent the possible movements of an asset over time, asset price over time.
Okay. So it's a model. It is used to represent the possible future price of a stock
Mm,
or over discrete time intervals. Correct.
yeah.
So at each time step, you can see age to age like that. The stock price is treated as a discrete random variable. Okay. That means instead of having, infinitely many possible prices, the stock price can only move in two directions, two possible outcomes. What are they? Up increases by, first of all, two directions, factor U, and down. Then obviously it will have a decreases by a factor D. Now, what are the two possible outcomes? The assumption of two possible outcomes makes the model, simple but powerful. It captures the uncertainty of stock movements. Okay, and makes the calculation manageable. Okay, and it allow us to simulate a lattice or tree of possible price path. Let's do an example like current stock price. Okay, so that is S naught, that is 100. Now in the next step, the stock can either, I told you, go up to S naught multiplied by U. So that is 120 when you have to multiply. So suppose U is 1.2. Okay, and it will go down. It will go down to S naught multiplied by D when to 90. When if D is 0.9. Okay, so after one step we have S1 is 120, 9. So after two steps, the tree looks like, how? The general structure.
Mm,
After two steps, the loop will be up. That will be up is not multiplied by U square. Up, that is down, or down to up. That is S naught multiplied by U multiplied by D. And down means
S naught times D square.
this branching process continues for multiple steps. And finally, what you get is binomial lattice. Okay. So binomial tree is a discrete time model where stock prices can either move up or down at each interval. And this forms the basis of option pricing model, that is binomial option pricing model. Okay. First, one period binomial tree. So what is the current stock price? It is starting at S naught. And after one period, time is H. So at the end of the period, the stock can either go up or down.
Yeah.
So this is why, it's called a binomial model. Only two possible outcomes. By
Mm,
relationship between prices, the model assumes this one. Okay. An example I have already told you. The one, it is why it is important. Okay, just hang
Hello?
Yeah, I'm there. The screen has hanged. Okay, the one period model forms the foundation of option pricing. When I was telling that why it is important because it has become once the possible stock price at time age, you
Mm.
can compute the possible payoff, correct? Like call or put, and then work backward to find today's fair option price, and that you can do using risk neutral probability. So in summary, the one period binomial tree assumes a stock which can only move up or down in a period and only two possible outcomes. And this simple framework is the first step towards more complex process and ultimately will lead to black. Scenario is clear?
Yeah.
Now, this is one period. Again, they have given some instance. What are SU and ST? Told you. What are SU and ST? Okay, so the next slide you can see.
Yeah.
That is slide number 7.
7.
Just tell me then, what are SU?
SO is 100,
Mhm.
U is 1.2, and D is 0.8.
No, no. Where the values are written? This one.
Aren't
I'm
we
on the
on
next.
example? Okay, okay, here.
Yeah.
I was in slide
Slide
8.
number. Yeah.
Yeah.
So after one time step H, the stock can either move, that is S naught multiplied by U, or down S naught multiplied by D.
D.
So the possible values,
For U are more than 1, and D is less than 1, right?
of the after one step are SH, S naught U, S naught D. Okay. So here, these are the conditions. If I talk with you, it ensures U greater than 1. That means it ensures the stock goes higher than S0. And when it is this one, then it ensures the stock goes lower than S0. Naturally, this is the condition. SU, S0, ST. The one period binomial stock price can move on or down by factor. This simplification building block for option pricing, and that is using binomial tree.
Mm.
This is only in explanation. What are U and D then? Multipliers.
Okay.
So, any question? New topic we are doing. Any question there?
No.
So here, U and D are the multipliers. Okay, that determine how the stock price changes over one period. Okay. So, they describe the percentage change. In stock price when it goes up or down. So U is greater than 1 means stock price increases. And D is less than 1 means stock price decreases.
Decreases.
And mathematically, how we will write that? Mathematically, SU is equal to S naught multiplied by U and SD is equal to S naught multiplied by D. Okay. So here, now you tell me the sum. I think you are telling about this sum.
Mm.
So here, current stock price is what? 100.
Mm.
This is U 1.2 and stock goes up by 20%. And when D is 0.8, then stock goes down by 20%.
20%.
So after one period, what will be the value? SU will be 100 multiplied by 1.2, that is 120.
Mm.
T will be 100 multiplied by 0.8, that is 8.
80.
So that means after time age, the stock can either be 120 or 8. Now, when U and D are not given, when U and D are not given. So here in practice, U and D are often estimated using volatility of the stock. So a common approach is from the Cox-Ross-Rubinstein model, CRR model. E to the power sigma t. So here D is what? E to the power minus root t. So here, what is the volatility? Of the stock. So it is basically nothing but standard deviation of returns. Okay, and what is this? Length of time step.
Mm. I think this chapter is actually really easy. It's just the problem would be like memorizing all the formulas.
Exactly. And this ensures the model reflects the actual risk or uncertainty in the stock price. So U and D are what? U and D are the upward and downward multiplier which determine possible stock price in a binomial tree, and they may be given directly in a problem, or if not, they must be estimated using volatility based formula.
Okay.
Next, yeah, one period we will model the stock returns. Okay. We will model this stock. So here there is formula for, as you stated, U and D. Okay. This represent what? This represent the multiplicative factors for the stock price moving up or down over a period of length h. So what is the explanation of the terms? What is R? Continuously compounded annual interest rate. It captures what? Captures the time value of money.
Mm.
Okay. What is this? This is continuous dividend yield. It will do what? It reduces the growth rate of the stock. Why? Since dividends are paid out to shareholders. Okay, what is age? Length of one binomial step. So that is like I told you one step. So if one step is 3 months, then what will be age? 0.25. And this is your annual volatility. So here, higher volatility means more uncertain. Okay, so bigger potential jumps up or down. See here, if you see these are the explanation for the terms.
Okay.
Here, if you see the equation u is equal to this. So here, this r minus lambda h, this represents what? This part, r minus this, it represents the expected drift. Expected drift means growth of the stock after adjusting for dividends.
Mm.
Okay, and this one, the other term, sigma, this is the uncertain volatility effect
Mm.
over the period. So here it adding give up the up factor and subtracting means the down factor. So here if I do a sum with you,
Mm.
R is 5, this is 2, this is 20, and H is 0.25 3 months. So now for the calculation, U is e to the power 0.05 minus 0.02, 0.25 plus 0.20 root over 0.25. And that is e to the power, to calculate 0.75. So that is 1.113 U. And what is D? E to the power 0.05 minus 0.02, 0.25 minus 0.20 root over 0.50. So that is e to the power 0.0075 minus 0.10, that is e to the power minus 0.0925. That will be 0.912. So the stock goes up by 11.3%
Okay.
or down by 8.8% in one step. Next, Okay, they have given and they have given to find out that one. Just, just try to find out. Formula noted.
Yes.
But what is the value coming? Just tell me. S0, that is the current stock price. Continuously compounded annual risk-free rate. This is what?
SU.
SU.
No, 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 no. I was calculating that.
Okay.
Yeah.
Risk-free rate.
Yeah.
And what is this? Volatility. Continuous dividend yield. What is H? Length of binomial step, that is 6 months.
Mm.
And this is volatility, annual volatility rather. So
Yeah.
find this and this. Formulas, as I told you,
Yeah. I already found them. It is 1.217 and then 0.854.
0.85. But that will be on percentage.
Yeah.
So SU is, you're putting on the formula, S naught multiplied by U, and SD is S naught multiplied by D. Okay.
Mhm.
What is your SU coming? 1 to 1.7. This one will be 85.5.
Yes.
So this means starting from 100, after 6 months, the stock can either go up or can go down to this.
Mm.
Good. Okay, next we are having the tree itself. So there can be two possible outcomes for the stock price as tree. So at time 0, the stock price is how much? S naught. Time H, the stock can either go up SU or down SD. Again, since the option value depends on the stock price, the option will also have two values. CU, if the stock goes up to SU, and CD, if the stock goes down to SD.
Mm.
And at time 0, the option value is C0. So now option payoff structure. For a European call option with strike price K. So CU is max of SU minus K comma 0. Okay. And CD similarly will be max of ST minus K comma 0. This is for call. If I talk about for a European put option, P of U will be max K minus SU comma 0 and D will be max of K minus SD comma 0. So just as the stock has two possible prices, after one step, the option has two possible payoffs.
Okay.
Why important? This sets up the binomial option pricing framework. Correct. You're determining possible stock prices, then you're determining the risk neutral probabilities. Because the stock price, can either move up or down. The option value will also have two possible outcomes at expiry. So this parallel structure allows us to compute option price using the binomial tree method. Next, we are having a sum. Eight 8.2. Using information from 8.1. So here, what is S naught? 100. SU is 1 to 1.7
Yes.
from example 8.1.
Mm.
And what is SD? That is 85.5. And what is our time horizon? 6 months. So here with strike price 100, how we calculate the formula? So here K is 100 for A. So C is max of ST minus K0. So if stock goes up to 121.7, then CU will be max 121.7 minus 100 comma 0. So that is 21.7. And if stock goes down to 85.5, then CD will be max of 85.5 minus 100 comma 0. So that is 0. So then what will be the call option payoffs?
21.7.
So C will be 21.7 and CD will be 0.
0.
This is first sum. Now we have to find out the second option, that is put option strike. K is equal to 95. So what is the payoff formula?
K minus ST.
P is equal to max K minus ST comma 0.
Yeah.
So here, now we see if the stock goes up to 121.7. If the goes up to 121.7, so then PU will be max 95 minus 121.7 comma 0, that is 0. And if the $85.5 max of 95 minus 85.5 comma 0, so that is 9.5. Okay, so the put option payoffs are 0 and 9.5. So the call option only pay off if the stock ends above the strike. The call option only pays off if the stock ends above the strike. Okay, so here only in the up state. And here if I talk about put option, the put option only pays off if the stock ends below the strike. So that is here only in the downside. So final results we got.
Yeah.
Tomorrow you are not having exam, correct?
Yeah, tomorrow no.
So tomorrow you can do the class.
Yeah, sure.
Okay. So
But
then tomorrow,
I can, because I have also work. I can only do
Mhm.
it after like 4 p.m. Indian time.
So at 4 p.m. you can do, na?
4 p.m. here. It's like 6:37. Yeah, I can do like
4
4:30. I
to
can
5
do.
we can, yeah. 4 p.m. we can keep then
Okay. Yeah. Sure.
tomorrow. Okay.
Yeah.
Okay.
Okay.
Okay. Then tomorrow I will finish the rest of the part. Okay.
Okay.
Till 30. Yeah. So revise at home. Okay.
Yeah, I will.
Okay. Okay. Thank you.
Bye bye. Thank you.
Bye bye. Yeah.